Hello, everybody, and welcome to the Dorsey Wright podcast for this week is June the 14th. Jay Gragnani here. With me as well is Will Gibson. Will, great to have you on once again for another discussion. And this week, what we wanted to do is spend some time talking a little bit about commodities in general. In last week's discussion, Will, we talked about the energy space at large, not only in the strength within some of the individual stocks, but also within things like crude oil and commodity area of the energy market. What we wanted to do today is discuss a little bit broader the commodities, not just crude oil and energy, but really looking at the broad spectrum. And a lot of that discussion, we've seen a lot of strength in commodities, and we've seen it for a number of reasons. But coming on the heels of last week's CPI numbers coming out, which continued to increase, that CPI index continuing to move higher, a little over 0.5% month over month at the ending of May, with a lot of the CPI index up over 5% over the past 12 months. And so there's a lot going on in there. There's a lot to unpack when you dig in and look at some of those numbers. A lot of interesting things that we wouldn't otherwise think about as being big drivers of increases in that. One of those, interestingly enough, one of the biggest areas of that being the auto industry, with used cars increasing quite a bit today. But Will, as you and I were talking, it's certainly conversations around the dinner table look much different this year than they did, say, at this time last year. Well, a couple of things look different. One is we are gathering around the dinner table with other people that are outside of our household, but those discussions have gone from something very different a year ago to now a lot of discussions around just the general price of things that we're consuming have increased, and that's what you see reflected in those CPI numbers. The cost of things, whether it's cars, whether it's gasoline, whether it's the food that we're eating, it seems that across the board we're seeing the increase in the prices of those things that we're consuming have gone higher. And a lot of reasons for that is the underlying inputs to those goods that we're consuming, the actual raw material costs have increased quite a bit over the past year, Will.
Yeah, Jay, no shortage of that. And I definitely resonate with the dinner time conversations. Even just friends, it seems like commodity prices are becoming a hot topic of conversation. People are much more educated and up to speed on lumber prices and oil prices and copper prices and all of these things. So it's been an interesting time, especially being in the industry, to talk with others outside of the industry on things that they're seeing. And Jay, you mentioned that CPI report, the automotive being a huge part of that. And we actually were looking a little bit into this. It looks like, so used car prices were up almost 30% since this time last year and over 7% in the past month. A large part of that you're seeing is a supply shortage, Jay, like you're saying, on the materials front. Semiconductors, or those chips, are in short supply, and you can see it visually just driving down the road. A lot of those new car lots are running on very low inventory, and you're seeing those new car prices tick up in price as a result of that. So about roughly a third of that increase in CPI was attributed in some sort to the automobile. But again, Jay, like you said, across the board, airline tickets, travel, food away from home, even a better rent prices are going up. And on those underlying input costs for a lot of these things, it has been an astronomical rise, almost widespread across the board in commodities, really since the latter part or midpoint of last year, when we started to see a bit of positive economic data after the COVID sell-off. Precious metals for a lot of the year in 2020 were leaders. Gold in particular had a very strong run, as it was acting perhaps as expected as a bit more of a defensive hedge or an uncorrelated kind of physical asset hedge in the market. But later months certainly sold off. You saw widespread participation. If you took a dart and you put all the commodities together, your chances of hitting one that appreciated double digits was probably pretty good. From agriculture to base metals to energy, just tons and tons of participation. But Jay, maybe we'll start here with some things that are contrary, so some things that have cooled off recently, and then we'll follow up with things that are still pushing to new highs. and then maybe we'll come in and talk about, ways to be invested or investments to watch towards the end that may still be related to some of those moves. And we were recently put in our report some commodities that were starting to show some signs of cooling off. So people maybe are thankful for some of these cool offs. Finally, lumber is a huge one. That's been a big topic. If you're trying to get into the housing market, if you're trying to build a new house, doing an upgrade to your house, even just walking through departments, you're going to see a shortage of lumber, and that's been reflected in the prices. Meteoric rise over the past year, but really in the past month, you've seen a pretty notable pullback, almost 30% in lumber prices over the past 30 days. Even the past 15 days, you're down almost 20% in lumber prices. So you've seen that take a breather after pushing to highs time and time again. And if you're on our platform ever and pull up that lumber chart, lumber continuous is LBS/, and we'll put this chart on our YouTube video as well. But lumber has now given 2 consecutive point figure sell signals on its 25-point chart, which is just a less sensitive look at the commodity, given that it tends to move in rather extreme fashions. So trying to smooth out some of that volatility, but 2 consecutive sell signals, seeing that sellers have stepped in greater amounts 2 times in a row now. We'll see columns of O's exceeding a previous column of O's in 2 occasions. Last time you saw 2 consecutive sell signals for lumber was October of 2020, which at the time ended up to be a pretty decent bottom, and the commodity continued higher. Now I would add that although we are at 2 consecutive sell signals, we're in a point where there's not a ton of support at the moment. So any movements from here or any points at which buyers step back in, Jay, I think are going to be really interesting there. And another commodity that I would mention in addition to lumber prices are going to be your platinum and copper. One more on the precious metal, one more on the base metal side. But those have both also cooled off. Platinum was testing its trend line last week, and then copper has formed a double bottom right now. It hasn't broken through and returned to a point figure sell signal, but you are seeing a pullback and a breather, Jay, in a lot of those commodities, which really felt like forever, and it felt like it wasn't going to come for a long time.
Yeah, and it's funny you mentioned lumber, and you think back to times last year, and there were pictures circling around the internet and even amongst friends where if you went into a Lowe's or a Home Depot or a home improvement store, and literally the entire lumber section was wiped out as the demand for lumber was just so high, the supply wasn't there. And that's, what we talk a lot about is just this battle between supply and demand in the marketplace is absolutely evident when you look at a lot of these commodities, and the prices are going higher because there's so much demand for them. Who knows now, maybe as we're entering the summer months of this year, you're seeing, lumber prices have cooled off a bit despite still being up over 200% over the past 12 months. They pulled back a bit here as we're entering the summer months of 2021, and we're continuing to see things like crude oil and a lot of the energy related commodities pushing to new highs. And so maybe the marketplace out there is looking at that, and we're starting to see some of the construction projects cool down a bit as people are focusing more on vacations and travel and energy consumption over the course of the summer. I know I and my family are certainly looking forward to getting away and having some vacation time this year down around the beach. But it's just interesting because you mentioned the cooling off of some of that, but crude oil pushing up to $71 a barrel is something that continues to perform well, continues to be among the areas of the commodity market that is ranked very highly in our what we call our relative strength matrix. And so one of the areas of our website, well, you mentioned some areas on the site, and we have a matrix functionality that just simply ranks all of these commodities versus each other. And when we look at that today, we continue to see a lot of those energy commodities up there towards the top, with lean hogs, interestingly enough, also up there towards the top. When you think about commodities and we think about crude oil, we think about gold and silver, to more of an extent over the past 12 months, lumber started to be part of that conversation around, individual commodities, and copper from its industrial use. Not only industrial use in the sense, but then also in housing, using with copper gutters and wires and all that kind of good stuff. But lean hogs is certainly not one that many people think about. But lean hogs, when we look at about 20 different commodities, sits right up there towards the top of the relative strength matrix, along with crude oil, heating oil, gasoline, and then copper rounding out the top of the top 5 list, if you will. Down towards the bottom are where you see some of the precious metals, gold and silver, and then cocoa also down there towards the bottom when we're looking at that relative strength matrix. But these are all, again, looking at the individual futures. And so if you're thinking about this and say, how can I gain exposure? What are ways that I can look at this rise in the general cost of things and gain exposure and participate in that movement to the upside, short of opening up an actual futures account and futures contracts? Because there's a lot of size, a lot of leverage when you think about futures contracts. But there's a couple ways that we talk a lot about, ways for investors to gain exposure to the commodity market. And with the proliferation of ETFs over the past number of years, the access to the commodity market has never been easier for individual investors to gain exposure to just a basket of broad-based commodities, but also some individual commodities here and there through ETFs. And there's a number of ETFs out there that you can do it. A lot of those ETFs are going to invest in the futures contracts for you. So if you wanted to buy just a basket of something like an Invesco no K1 commodity ETF, PDBC is the ticker symbol on that. That is an ETF that's going to own a basket of commodities, everything from crude oil and heating oil to gold and silver and the likes within there. That'll give you access to a broad-based basket of commodities. And the no K1 part of that means that there's not going to be a K1 statement issued. There's some, when you're investing in ETFs or products that do invest in futures contracts, that's just one thing to be cognizant of. Oftentimes, and at least a lot of the new ETFs when they were coming to market, they would invest in futures contracts, which means they would generate K1 statements by the structure of the product. There are some on the newer ones. PDBC is one of those that has been out in the marketplace for a few years now, provides access to commodities, but does so in an tax-efficient way that does not generate a K1. So just something to keep in mind. I mean, the other side of that is accessing some other commodities like gold, as an example. There's 2 different ways to invest in gold. Basically, buy the physical gold bars and put them on a bank, or futures contracts. There's products in the marketplace that do both. They just understand the difference. In like something like a GLD owns the physical gold out there, so there's not going to necessarily be a K1 statement because it's not futures contracts. It is taxed a little bit different, so just be sure to understand that. And then there's also DGL, which is a gold ETF that buys futures contracts to get access to gold. So lots of different ways. I say this because there are a lot of different vehicles, a lot of different mechanisms to gain exposure to commodities specifically, but there's ways to do that in the commodity, or there's ways to participate in the rising commodity prices through just the individual equity markets.
Yeah, Jay, you're definitely right. And that's a tangible way to get into the space, by not just buying stocks that are heavily concentrated or work in that industry. Can be another way to get into the space without the leverage, without all of maybe some of the added risk of some of those individual futures, or of course some of the ETFs and notes will do it themselves. And maybe a few parting shots here, things that I was just pulling up to leave with today. A few talking comments, perhaps, maybe your clients or even individual investors talking amongst friends, some things that we're looking at in the commodity space to keep an eye on, or things that I think are going to be interesting to note going forward that could give us a direction of some things. One I would say is that we were looking at the falling dollar as a big tailwind for commodities. So that's going to be a key point to keep an eye on going forward broadly for this space. If you're considering, if you want broad commodities exposure, or even if you want some more satellite concentration, like in some of the products that Jay was mentioning, I think keeping an eye on the dollar, falling dollar typically being a tailwind, rising dollar, again, typically maybe a bit more of a headwind for some of the commodities. That's something to keep an eye on. Right now, we're still in the falling dollar side, so we haven't seen that materially change trend yet. Now, the other thing I would say is that there's a few spreads that we'll look at. That's not to be overly complicated, but one that I think is really interesting is a copper gold ratio that takes price of copper over the price of gold, and you plot that reading over time. And then if you actually overlay interest rates, so the 10-year treasury yield with that, it actually tends to correlate with some of those moves. Reason being, copper, a base metal, widely used, as Jay was talking about earlier in industrial production. It's called Dr. Copper. Oftentimes in the market can act as a leading indicator for economic uptick in activity. And then gold being the denominator of that, which is typically a more defensive asset. It's typically physically backed and less volatile to some of those extreme moves, and acts as a safe haven, or at least has in times past. So copper gold ratio really started taking off in the mid-summer months of 2020, really preceding the rise in interest rates that we saw as a result of that. But more tangibly, I think the takeaway here is that copper has cooled off, gold has seemingly found a bottom, and that's been a bit of a decent, better performer in recent weeks in the precious metal space. Interest rates, again, did rise, I would say materially, but have since kind of stabilized and trended lower a little bit in recent sessions. So you have seen that copper gold spread with interest rates start to tighten a bit again, which is maybe expected given the historical trends, but that's another thing that we would take a look at. So copper coming down a little bit, gold coming up a little bit, and then rates more or less where they are now. That could be another thing to keep in mind, Jay. But apart from those spreads, I think the commodities market and markets as a whole seem very tangible right now. It's very easy to be involved. Even just paying attention to what's going on around you, I think, is a great way to stay up to speed on this market. And it's very supply and demand centric. It's very notable when you have demand outstripping supply, as we're seeing is the case right now. A lot like going on vacations, energy related, travel, food, all of that, maybe seeing some benefits of the pent up demand. Maybe we see supply catch up, and some of the rapid increases in price subsidized. And then another tangent coming in is that you have a big push for electrification. So a lot of green initiatives, copper being a big component of that electrification, home building being a big trend right now. Copper, again, another big use there, lumber as well. So there's a lot of kind of, I won't say messy, but multiple variables coming into play here, all of which are very tangible, Jay. And I think it's a really fun space right now. Great for investors, a lot of space for active picks, and really just hopefully a lot of great dinner conversations coming forward with people engaged in this market right now.
Yeah, absolutely. You're spot on there, Will. And from our perspective, commodities as an asset class is relatively strong, being the number 2 ranked asset class when we look at kind of the broad spectrum just behind U.S. equities. So from that standpoint, the commodity market at large has a good relative strength picture today. And when you look historically at commodities, is one of those asset classes that can often help diversify overall portfolios, because commodities in general tend to be less correlated to movements of equities. So it brings a diversification aspect to a broader portfolio construction as well as inflationary hedge as we continue to see the CPI numbers moving higher. So with that said, absolutely lots of opportunities to invest in the commodities market, whether through individual commodity ETFs or products, or through some of the companies that are involved in either the production of some of these commodities or the exploration of some of the natural resources like crude oil and the like. So but lots of opportunities there. If we can help answer any questions for you, please don't hesitate to reach out to us, 804-320-8511, or our email, dwa@dorseyright.com. With that said, Will, thanks for joining for our discussion again today. Thank you all for listening and tuning in to listening to our discussion on commodities, and we look forward to talking to you next week.